10:01, I think we'll get started. So first, I'd like to say good morning and welcome to our Sustainable Investing webinar, at which Steve and I plan to review 2018 Sustainable Fund developments and our 2019 outlook. And in addition, we will discuss the topic of conducting sustainable investment manager due diligence. And then at the conclusion of our remarks, we'll have a Q&A session.
Good morning, everyone.
So that was Steve that you just heard. My name is Henry Schilling, and thank you all for joining us yet again after our technical difficulties earlier in the week. And I do also want to offer a special shout out to my LinkedIn contacts for being so supportive and your kind notes. Thank you. So Steve and I are with Sustainable Research and Analysis, and Sustainable Research and Analysis is an independent firm offering, or I should say specializing in sustainable investment funds, their management and distribution. We maintain the website sustainableinvest.com. Our goal at Sustainable Research and Analysis is to provide financial intermediaries and fund professionals and as well as investors with critical insights and research to support their clients' sustainable investment needs. So to begin, I just want to make clear, and I'll shift down to the next. Well, the next slide is the agenda, and on slide 2 you can see introductions. We're going to talk about 2018 Sustainable Fund developments and 2019 outlook, and then go into the discussion of sustainable investment managers due diligence, and then open this up for Q&A. But before I begin the formal remarks, I just want to make clear that when we refer to sustainable investing, and this is laid out on slide 3, which you should be able to see in front of you, we use it as an umbrella term to capture at least 4 broad sustainable investing strategies. And these extend from negative screening or exclusions, as these are sometimes referred to. This is sometimes also referred to as responsible investing and values-based investing. So that's number 1. The second is thematic investing or impact investing. The third is ESG integration. And then the fourth revolves around shareholder engagement and proxy voting. In terms of ESG integration, we think about the formal definition of ESG integration, which is one that is promoted by the CFA Institute, and that is the consistent and systematic accounting for environmental, social, and governance risks in investment decision-making where these factors are relevant and material to the outcomes. And also the last thing I would say is that when we're evaluating this segment of the market, we do so through the prism of mutual funds and ETFs. In total, there are 89 ETFs and almost 1,200 mutual funds and share classes, with a combined total at year-end 2018 of $390 billion. And this is a segment of designated mutual funds and ETFs that either, due to their explicit theme or prospectus language, qualify these funds based on their sustainable investing mandate. Now, as many of you may already know, this past year has been a challenging one for the asset management industry. And in particular, I'm referring to flows and year-end assets under management. Generally, investors continue to pull money out of active funds, and they've been placing assets into passive funds. But even more broadly speaking, standalone asset management firms or the asset management units of banks or other financial institutions have been reporting declines in revenues and assets under management. BlackRock last week, in its earnings announcement, for example, reported that assets declined by some 300 billion. Interesting that that's about roughly the number of explicit sustainable assets in mutual funds and ETFs. And that represented, for BlackRock, a 5% year-over-year decline. And also reporting declines during the course of their earnings announcements were firms like Goldman Sachs, Morgan Stanley, JP Morgan, Chase, and Charles Schwab. Now, this stands in contrast to what we have found in our research for sustainable funds in 2018. Namely that sustainable investment funds, which, as I said, ended the year at 390 billion in assets under management, and you can see that on slide 4, reached their highest level ever by adding $140 billion. This is up from 250 billion at year-end 2017, or a top-line increase of 56%. This is very good news for the sustainable fund segment, but it's actually a bit more nuanced. By far, the largest contributor to the increase is attributable to the rebranding or repurchasing of existing funds. There are really 3 factors that contribute to the increase in assets under management. One is this notion of fund rebrandings. The second is market movement, and the third is net cash flows. Market movement had the second largest impact. This factor depressed the value of assets by an estimated $27 billion. But the third component is cash flows, and positive cash inflows to sustainable funds during the year is estimated to have contributed 11.45 billion in assets. And this represents a more modest 4.6% of the value of assets at December 31 of 2017. So based on preliminary data, while the absolute number is quite small, it far outpaces the net cash inflows into long-term US mutual funds and ETFs that, according to Morningstar, was $157 billion, the lowest level since 2008, and represents a paltry 0.8% increase. So we're looking at 0.8% increase for the mutual fund and ETF industry generally versus a 4.6% increase for the sustainable mutual fund and ETF sector. You can see the components of that on slide 5 in front of you. 2018 cash inflows, 11.45 billion, or 4.6%. Now, before I go into additional details, I just want to highlight quickly some of the ESG-related themes and events that unfolded during the course of 2018. When we came into 2018, there was continued fallout from extreme weather, natural disasters, and sexual harassment revelations that had been experienced the previous year, but spilled over into 2018. And we were again confronted in early 2018 by gun violence and the use of semi-automatic style weapons because of the horrific Parkland, Florida mass shooting. Then, at roughly the same time, Larry Fink at BlackRock issued another letter to CEOs arguing that, in quote, society is demanding that companies, both public and private, serve a social purpose. And related to this, a number of research articles and commentary focused on the theories of corporate profits and shared value and advocating for the adoption of long-term strategies. PIMCO expressed a view that a quiet and profound pivot is underway in the sustainable investing space, with respect to fixed income. And there were also new revelations about Facebook's data protection and privacy breaches. There were continued actions on the part of the Trump administration's EPA to roll back environmental regulations. The 2018 proxy season was notable for the high level of environmental and social proposals, as well as a number of majority vote outcomes. The DOL, the Department of Labor, struck a more cautious tone regarding ESG-themed investing within the context of fiduciary responsibility, even though we believe that they conflated socially responsible investing with ESG integration in their guidance. The Task Force on Climate-Related Financial Disclosures, the TCFD, which was the formation of which was announced at the Paris Climate Accords at the end of 2015 and was launched in 2016, published its first status report, which also indicated that industry support for the reporting initiative was continuing to grow. There were also several authoritative scientific research reports, this was in the latter part of the year, published on the status of global warming and climate change. And the report concluded that the world continues to emit historic levels of carbon dioxide and other greenhouse gas emissions, and the impact of this was accelerating. And then towards the end of the year, the 24th Conference of the Parties to the United Nations Framework Convention on Climate Change, or COP24, was held in Poland, and an agreement was reached by climate negotiators to bolster the 2015 Paris Climate Agreement. And then lastly, I should mention the Forum for Sustainable and Responsible Investment, or USIF, which reported that through the beginning of 2018, assets linked to sustainable, responsible, and impact investing strategies reached a total of $12 trillion. And much of this growth was driven by asset management who now consider ESG factors in their investment decision-making. And while I must say that I'm still somewhat skeptical about the top-line numbers for reasons of double accounting, definitional issues, and so on, the overall increase reported by USIF is consistent with the growing attention to this general area, even though perhaps as much as 50% of the assets sourced to sustainable strategies may be linked to exclusionary or negative screening practices, avoiding companies that invest in tobacco, weapons, alcohol, to mention just a few. Now, with that as a background, I'd like to jump back now to asset growth, which, as I said, is sourced to the three factors, and in order of their importance: fund rebrandings, market movement, and net cash flows. And I'm moving now to slide 6, which shows that during the course of 2018, 90 separate funds from 25 separate fund companies repurposed or rebranded existing funds by adopting sustainable investing strategies, which again, as I noted, accounted for almost 156 billion in assets. What you see here is the quarter by quarter increase in assets attributable to the strategy, and at the same time, the number of funds involved. And that's the actual number of funds. The largest number of rebrandings or the repurposing of funds occurred during the fourth quarter, when two firms in particular, JP Morgan and American Funds, American Mutual Fund, rebranded 14 funds with combined assets of $88 billion. What JP Morgan did is take a bunch of existing funds and adopted ESG strategies going forward. while in the case of the American Mutual Fund, the company adopted a negative screening policy that involves alcohol and tobacco products. As I said earlier, positive cash flows were estimated at almost $12 billion, and part of this is attributable to new fund formations in 2018. There were some 90 fund launches, new launches in 2018, and these consisted of both mutual funds and their corresponding share classes, as well as exchange-traded funds, with a total value using the valuations at December 31 of 2018 of $2,600,000. And as you can see on this slide 7, 2018 was not actually the best year for new sustainable fund formations. That designation belongs to 2017, when a total of 112 new mutual funds and their share classes, as well as ETFs, came to market with about $4 billion in assets. Now, I don't have time to go into the sort of observations that can be made about these new funds, and we made some of those observations at our last webinar. Maybe if time permits, I can come back to that, but in the meantime, if you're interested in some of the themes that we saw come across, you can refer to an article that we published on our website just the other day, and that has all of the details. What I also think is important is, and now I'm moving to slide 8, it is also useful to dimension new funds by their sustainable investing strategies. And what we try to do here on slide 8 is portray those 90 funds by their broad strategies, including more than one strategy where that was applicable. So what we actually did, we looked at the 90 funds, we referred back to their registration statements or their offering documents, and based on the information that was disclosed by the companies, we tried to classify, but we did classify these companies into the broad sustainable investing approaches or strategies, and that's really summarized here. Leading the new sustainable funds landscape in 2018 are investment vehicles that have adopted ESG integration strategies, along with funds that combine 2 or more strategies on top of ESG integration. New funds that have adopted ESG integration strategies number 16 with 881 million in assets, or 34% of the new funds. That's really the top line. And the number expands to 52 funds and 1.8 billion, or 70% of the total, when ESG is combined with impact, thematic, negative screening, shareholder engagement, and proxy voting. The adoption of at least the 4 broad-based strategies and even larger combinations of 2 or more of these that are further multiplied when these strategies are actually implemented at the security and portfolio level, we believe leads to a baffling number of options for investors and contributes to confusion that we think, particularly in the absence of clear explanations around how these strategies are implemented and transparency on their portfolio, affects performance results, and impact outcomes. This means that investors have to spend more time understanding the approach each manager is taking and expected outcomes. And this could be leading to sustainable investing paralysis. I also want to just point out that at the end of 2018, and this is reflected on slide 9, 127 firms were offering designated sustainable mutual funds and ETFs. And this compares to 107 funds at the end of 2017. So there's been an increase of 20 firms, or a 19% gain. The largest 20 fund firms account for almost 89% of the assets in the segment. And these firms, which are listed on slide 9, manage 343 billion in assets between them. The concentration is actually slightly below the 90% level that we saw at the end of 2017. And before I move on from this slide, I should point out that the profile of the largest firms has actually shifted in the last year as more of the traditional or mainstream firms established a presence in the sustainable sphere by repurposing existing funds or introducing new funds. So we have firms like Legg Mason, Aberdeen, Jensen Investment Management, Pioneer Investments, JP Morgan, Morgan Stanley, and Dreyfus moving up into the top tier segment, while firms like Ariel, Amana, and Domini, a long-standing sustainable investment firm, trended lower in the course of the year. I'm going to switch now to a few comments about the performance of sustainable funds in 2018. 2018 turned out to be a very challenging and turbulent year. The S&P 500 index posted its worst performance since 2008. On the other hand, investment-grade bonds, which were in negative territory actually all year long, gained almost 2% in December, 1.84% to be exact. And this lifted the Bloomberg Barclays US Aggregate Index so that it ended up in positive territory for a year, gaining 0.01%. Now, sustainable mutual funds and ETFs were actually not spared. Across all funds, these investment vehicles posted returns for the year that averaged minus 7.7, with a median total return of minus 7.2. And returns ranged from a high of 11% to a low of almost minus 30%, registered by an ETF fund that focused on China environmental stocks. This, by the way, excluded, if you can believe it, a return of 226% that was posted by a small and very volatile on a month-to-month basis exchange-traded note offered by iPath. It's the iPath Global Carbon Fund that invests in carbon credits. Now, this is a pretty unsophisticated way of thinking about the performance results for this segment. Another approach is to review the performance of sustainable funds via two benchmarks that we created to track the performance of sustainable funds in a consistent way. And the first benchmark, and this is what is displayed on slide 10, the first benchmark tracks sustainable large cap equity funds. This is an index that we initiated as of June 30 of 2017, with data going back to the end of 2016. And it tracks the total return performance of the 10 largest actively managed large cap domestic mutual funds that employ a sustainable strategy beyond absolute reliance on exclusionary practices for religious, ethical, or social reasons. So to qualify for inclusion in the index, and the 10 funds that comprise the index are included in the appendix, the funds have to have in excess of $50 million, and they must proactively apply environmental, social, and governance criteria to the investment process and decision-making. And in tandem with their ESG integration approaches, these funds may also employ exclusionary strategies along with impact-oriented investment approaches and shareholder advocacy and proxy voting. So we call the first of these two benchmarks the Sustainable Large Cap Equity Fund Index. And the index posted a decline of minus 5.3% during calendar year 2018, as compared to the S&P 500, which was down minus 4.38%. So a negative differential for sustainable funds in this space of 92 basis points. Now we, as I said, started to calculate this index as of December 31 of 2016. And so during the first year, the index also lagged the S&P 500, and that lag was so the index registered a gain of 19.1% in 2017 versus 21.83% for the S&P 500. And the cumulative two-year lag is now 3.7%. Interestingly, one fund that, and this is one fund out of 10 that make up the index, is the only fund that exceeded the performance of the S&P 500 for two straight years, and that's the Calvert Equity Class A shares, which exceeded the performance of the S&P 500 by almost 4%. The second benchmark is one that tracks bond funds. So these bond funds are selected based on the same basis that we selected the equity funds, but there aren't enough bond funds to create an index around 10 funds, which we think is the minimum appropriate number for this type of a benchmark. So we call it an indicator. It only tracks 5 funds. You can see the composition of the index in the appendix. And for 2018, the benchmark fell behind the equivalent conventional index, which is the Bloomberg Barclays US Aggregate Index, that gained 0.01%, while the indicator experienced a slight decline of 0.05%. So a fractional difference of 0.06% for 2018. We can certainly answer more questions about these benchmarks at the conclusion, but I just want to end up, before I turn the discussion over to Steve, by reviewing our 2019 Sustainable Funds Outlook. And there are 5 observations that we make here. The first is that ESG integration will, in our view, continue to gain traction in 2019 and is eventually expected to reach mainstream status. And the reason for that is primarily because of the increasing evidence that is supporting the fact that doing so can achieve positive results while at the same time mitigate risk. So that's number one. I don't think we're going out on a limb on this one. Second, most leading asset managers have introduced designated sustainable funds. Most leading asset managers. And by that, we're really looking at the sort of the top 20 to 25 asset managers globally that operate in the US. Even in the light of positive inflows that I had identified earlier in the discussion, we think that given the recent uncertainty and volatility in the markets, new fund formations within the leading asset management segment is likely to take a breather in 2019, whereas smaller and medium-sized firms are more likely to launch new products or repurpose existing ones. Now, while client demand is strong based on survey data, and in particular, this appears to be the case among millennials and women investors, existing funds actually have a strong institutional component, and new funds are weighted when you look at the assets that sourced. When you look at the assets that have been attracted by new funds, they're weighted in favor of institutional investors of various types. So we think that retail flows will be constrained, and the reason for that, in our view, is the fourth point that we make, which is related to the baffling number of sustainable investing options and approaches that leads to confusion and, in our view, to stimulate retail-oriented cash flows, asset managers and financial intermediaries will have to increase emphasis on sustainable investing education, reporting, and disclosure. And lastly, we think that there will be continuing improvement in the quality and coverage of ESG scores and ratings, and an expansion in the number, type, and quality of ESG indexes. And with that, I'll turn over the discussion to Steve, who's been sitting here patiently.
Well, I've been very interested in what you're saying. Yes.
Well, that's good to hear.
I do have a couple questions, but I'll address them later if we have some time. But again, good morning to everyone. I am going to take a few minutes to speak to the due diligence process for sustainable managers and try to highlight a couple major points. With that understanding, I want to just let everyone know that Henry and I plan to put together and issue fairly soon a paper following up on this topic. And we also plan on having a dedicated webinar to just the due diligence process, because there's a lot to get your arms around here. One aspect I should mention is that the sustainable investment managers and funds that I will be speaking to largely involve actively managed portfolios, although some of these questions will certainly apply to passive portfolios, and but to a lesser extent, I believe. I want to touch on two things, and if I have enough time, I'll cover the third a little bit more. But I wanted to start with some underlying considerations when conducting due diligence of sustainable funds and managers. And these are points that I think need to be kept in mind to really understand the distinction between sustainable fund management and non-sustainable product management. And then I will talk to the four different investment approaches and the emphasis on different aspects during the due diligence process. So with that said, what are some of the major underlying, I believe, constants when looking at sustainable investment funds and conducting due diligence of managers? And I've listed three. And these may be obvious, but again, I keep them in mind, and I think it's worthwhile for us all to think in these terms. But the first is, with sustainable investment funds, there are distinctive ESG selection criteria and portfolio allocation overlays. Now, that may be obvious again, but I think one of the things that I've experienced is that these criteria and the underlying metrics for the overlays certainly can be quantitative. They certainly may have a qualitative element to them, but they also, in some cases, may have an intangible element to them. And it's worthwhile to think in these terms, because very often, especially when you're dealing with product that may be sold to a retail client, that intangible comes into play. And so that's the first point. The second is, with sustainable investment funds and conducting due diligence, it's worthwhile remembering that there are additional portfolio restrictions and limitations at play. Again, fairly obvious, but worth remembering. And some of these may not have address financial aspects. They may be solely addressing non-financial sustainability considerations. And finally, I think this ties into the additional restrictions and limitations. With sustainable investment funds, you may very often be dealing with the manager having specialized analytical tools, utilizing very unique data and metrics, and employing a skill set in their management process, as well as having dedicated staff needs. And by dedicated, I mean dedicated to the sustainable investment questions that they're trying to manage to. Now, those are the underlying concerns and things to remember in my mind. There may be others. The next question I'd like to deal with is, and I think this is something that came through when Henry and I were discussing this topic, is, gee, there's different questions for different sustainable investment approaches. And Henry has mentioned these approaches earlier, and I'd just like to go through each of the four and identify those questions or queries that are worthwhile and I think important to bring up when conducting the due diligence process. The first, the exclusionary or negative screening approach. Obvious enough is the first question would be what industries, sectors, and securities are currently being excluded from the portfolio. But possibly more important is a second area of question, which is what criteria are used to define excluded companies, and I'm going to stress this, within sector and industry. And we're seeing more and more emphasis on that. Example, you'll have a fund that may exclude let's say a petroleum extractive concern or industry. And we're seeing managers now not taking that all or nothing approach, but saying, wait, there may be certain firms or companies within that broad industry sector that I want to include in my portfolio, because a lesser amount of their revenues, for instance, may be due to carbon producing operations or some other underlying criteria. And that's the important thing. What criteria are being used when looking within sectors and industries to select companies, and the amount of exclusion for those companies? And now finally, under the exclusionary approach, it's important to remember that you start excluding companies or sector, and by nature, you're concentrating others. And that introduces risk, and that introduces tracking area concerns. And it's important, I think, when conducting due diligence of these managers using this approach, to understand how they plan to control for that tracking error. So that's the first approach. Second approach, thematic and impact approach. Here, again, starting with the obvious, what ESG issues or themes are currently being targeted for action by the PM? First of all, I'm saying by the PM. It may be not up to one person to make the decision within a management shop. It may be committee defined. It may be a committee at the overall corporate level that is making the decision. But in terms of targeted for action, and I want to also, this is an underlying thought here, that action is typically revolves around buying more or adding to positions. And I think the second area, and this is the one that I find most important amongst these queries for thematic and impact approach is, how does the PM identify, select, and prioritize companies and impacts for action? Specifically, how do they establish impact objectives, outcomes, and possible benchmarks? Do they do it on their own within their shop? Very often, and I'd say most often, they work with companies who have specific interest, such as development zones. It could be housing development activities and so forth, and it may be a joint effort. But it's good to understand that. And getting back to the benchmarking of these objectives or thematic activities, what is the portfolio manager's process for measuring, tracking, and assessing a company's performance towards achieving those impacts or themes? Again, this will determine whether they reallocate on their portfolio or add to these positions. So those are the questions related to thematic and impact approach. The next is the ESG integration approach. Here, again, I start with the obvious. How are sustainable factors incorporated into the portfolio management process? But I would go one step further, trying to understand their weights as compared to other, and I say security selection, security selection and portfolio construction goals. That is the fund's mandates. And these may be what we traditionally think of investment style, growth exposure, risk level, etc. What is the trade-off when conducting an integration process? And as important, and we're seeing there's more discussion and in some cases controversy, what data, metrics, and methodologies are used when making and evaluating these sustainable selections? Very often we're seeing managers assessing companies' ESG quality and or risk, and establishing scores that they use to essentially select companies for the portfolio. And these scores or quality measures may be developed in-house. At the management may have their own methodology and models. And very often some will utilize third-party, outsource the scoring process. And this outsourcing area, third party, is I think an area that's gaining increased scrutiny. And it's worthwhile for when conducting the due diligence process to understand why a particular third-party provider was selected other than others, and what the pros and cons of that selection are. And then finally, under ESG integration, the broad area of inquiry for due diligence is concerns with the effects of the ESG integration process on fund risk, performance, and other portfolio characteristics. And I'm going to add, I guess, another difficulty to that process, and that is not overall alone for all markets, but looking at various phases of a market cycle, and understanding what sort of trade-offs is the manager making, if any, to integrate ESG factors. Okay, then the final approach is engagement, and I've included proxy voting approach. Here, the initial question I would pose to management is, how do they identify specific portfolio holdings and companies for engagement? And by engagement, I mean these are companies whose ESG quality may be troublesome and ultimately may be targeted for liquidation from the portfolio, or at least trimming back. In these situations, portfolio management, often sits down and works directly with company management to identify approaches to enhance their company's ESG quality. What determines, and this is, I think, is an important query of portfolio managers, what determines their level and the nature of involvement with these companies targeted for engagement? And a more practical aspect is, when does the portfolio manager decide to take an engagement action? And are there limits to how many positions in the portfolio a portfolio manager will conduct an engagement action with at a given time? If you have 150 positions in a portfolio, could all of them be targeted for engagement out? Or is there a practical aspect that the portfolio manager is taking into consideration? So those are the main questions I have under each of the different sustainable investment approaches. One thing I should mention, that there is, the questions under each are not exclusive to each approach. There's overlap among them. And the other side of this is that there's a possibility of varying levels of due diligence detail and attention that might be paid given a different sustainable investment approach. Now, with that said, and that's an awful lot, and as I mentioned, Henry and I are in the process of putting a paper together to address this in much more detail. And we will also have upcoming webinars to also address it. But one last thing I wanted to speak to on this subject, and I'll just touch on it briefly in respect for time, and that is, for all these approaches, as part of the due diligence process, it's important not to forget that there is a driving factor underlying each manager's focus on sustainable investing. And that is, and this defines possibly their ultimate success as managers, and specifically managing, if you're an institution or you're a platform, your assets and your clients' assets. And that is, what is the manager and its parent company's cultural commitment to sustainable practices? How do they run their own shop? Are they an environment where there's, I don't know, social, political or whatever discord? Do they have a history of providing other sustainable investment and or related products? I think these are areas that give you a sense of how serious they are towards the sustainable investment funds and product that you may be looking at. And it deserves, I think, its own dedicated review, which unfortunately I don't have time for, but I wanted to mention that just in passing. So thank you very much for your time this morning.
So with that, Steve and I have concluded our formal remarks. We'd like to open this up for Q&A. We've got another 9 minutes. I don't know if, I'm actually not sure whether you can direct the questions verbally to us over this site, but we'll take the risk and ask you to weigh in with any questions verbally. And alternatively, I think you can also type in a question, although I think I may have lost the specific capability to access those via the site in the form of a typed in question. So if anyone has a question, please shout it out. We'll see if we can grab it.
I have one just in the interim of you, Henry, and this extends on, unless there's someone on the webinar that's...
Well, there's one question that we do have, which is about the the general observations regarding funds. I mean, were you going to touch on that?
Well, you and I work, and I'm sure others think the same thing, and there are these different approaches to sustainable investing. Each has its own set of complications, and in certain respects, they are not the easiest things to understand, and certainly I imagine many investors and institutions are thinking the same thing, and I know there's been a lot in the media lately that this may be one of the problems with sustainable investment funds, and is that people just don't understand what they're getting. Do you feel there's a point at which the sort of these definitions and the transparency they bring with them is counterproductive in building the sector or building the sustainable investment product area?
Mm-hmm. Well, there is, as we identified during the course of our remarks, a baffling number of sustainable investing options and approaches, and that, in our view, does lead to confusion. There are also, I think, growing concerns, and I just saw an article in the FT about the concern around mis-selling.
Yes.
Some of these approaches and the type of outcomes that people are being promised and may be expecting.
I saw, by the way, advisors, the vast majority of advisors, I think this is a European-based survey, they're concerned and shying away from selling product because the last thing they want to do is place one of their clients in a product and lo and behold, it's holding a company that has a bad rep.
Well, there's clearly a need for additional harmonization of definitions, a clarification on what these various strategies actually encompass, what investors should expect in terms of outcomes, especially investors who are pursuing these strategies in order to achieve a positive societal outcome. And I think, importantly, a very important element in this is transparency and disclosure on the part of the asset management companies, which is currently lacking. And it becomes especially critical to reflect, whether it's in the form of semi-annual, annual reporting or supplemental reporting on the part of management companies, why certain decisions around portfolio holdings have been made, and what are the outcomes that result from the implementation of strategy. And I'll give you one quick example. If you look at Facebook, for example, and we know that Facebook has had issues around governance and certainly has had issues that we mentioned earlier around data security and data privacy. If you look at the world of sustainable investment funds, there is significant variation around holdings of Facebook, starting from 0 and going up to an overweighting relative to the S&P 500 weight. And yet none of the managers, yet many of the managers actually don't articulate what their position is relative to a Facebook. And I think that that's problematic both in the short term and long term. It is now...
Well, I would just add one thing. I think it's especially critical for the retail market.
Yes, I would agree. Well, it is now almost 11 o'clock and we want to be sensitive of the time. We want to thank you all for joining us on this webinar. We plan to have a number of additional webinars in 2019. And so I hope that you will join us for those in the future. As Steve said, we're going to have a paper on manager selection and due diligence, which also lays out specific questions that financial intermediaries, both on the retail and institutional side, can use in order to evaluate managers and fund offerings. And the last thing I would say is that if you have any questions that you haven't been able to address in the course of this discussion, please send us an email. You can reach us at henryschilling@sustainableinvest.com, and we will respond to each of you individually.
And I have put my Brett phone number on the top of the presentation I gave. So if anyone has any questions related to what either Henry or I presented, please feel free and comfortable to give us a ring.
Thank you very much. Have a good day and have a good weekend. Bye-bye.